Hi there, welcome back. In this second class about credit risk, we say something more about the loss given default and the PD. For what concerns the loss given default, we will introduce important concepts like those of workout LGD and market LGD, and we will try to understand the differences, also discussing what are the main features that can influence the loss given default or the recovery rate, if you prefer. For what concerns the PD, we will introduce credit ratings as a first way of playing with the creditworthiness of a counterparty. Enjoy!
Yesterday we started discussing credit risk, and if you recall, I told you that there are different approaches. We considered together the standardized one, the other two, the foundation internal rating based and the advanced internal rating based, are the topics that we will play with now. The big difference between the two approaches is that in one of the two approaches, the foundation one, essentially banks are, let's say, free to compute the PD, the probability of default, as they prefer, provided that they fulfill some requirements, while in the advanced one, they are also free to compute all the other quantities. Now, for us, the PD is the most important one, so we'll spend more time on that, also because of the complexity of entering into the modeling of LGD, EAD, and also up to a certain point maturity. So for what concerns those risk parameters, we will just say very basic things, and we start from the LGD, the loss given default. Now, the loss given default is a quantity that by definition lies between 0 and 1. Actually, this is a little bit of an assumption, because there are situations in which the loss given default in theory is slightly smaller than 0 and slightly larger than 1, but at least here we avoid those situations. What's the loss given default? When there is a default of a counterparty, we have an exposure with respect to that counterparty. So imagine that there is a mortgage and the guy defaults. So he's not able to pay back the mortgage. If I am the bank, I have an exposure with respect to this guy, which is actually the amount of money that the guy is still supposed to pay back to me. That's the exposure. This is what we call the exposure at default. Now, in situations like a mortgage, the exposure at default is something that is deterministic in the sense that there is almost no randomness, because we can always exactly know what is the amount which is still to be paid. There are other situations, like, for example, credit lines, credit cards, in which, on the contrary, even the exposure at default, it is not known. The loss given default is nothing more than the actual loss that we suffer, expressed as a percentage of the exposure at default. What do I mean? As I told you yesterday, when there is a default of a counterparty, is not that we lose all the money. There is an exposure, and then there are different procedures that all belong to the realm of recovery processes, such that going in front of a judge, going and speaking to the regulator, private settlements, and so on, I can find a solution to get back at least a part of the money. The loss given default is what I'm not really able to recover, and I express that as a percentage of the initial exposure. Okay, so it's for that reason a number between 0 and 1, or 0, 100%. So if there is a loss given default of 20%, it means that after the end of the recovery process, I essentially have a loss which is 20% of the initial exposure at default. Why I was saying that in principle it is between 0 and 1, but could also be slightly out, even if we do not consider that situation here, because imagine, for example, the situation in which you are not only not able to recover something, but you also have legal expenses. Or the opposite situation, you are able to recover everything, and then because of the intervention of a judge, your counterparty is also obliged to pay some extra things. Okay, so in principle, it can happen, but they are always marginal quantities with respect to the exposure. The loss given default is what we actually lose as a percentage. 1 minus the loss given default is the recovery rate. So if I have a loss given default of 20%, it immediately says that I have a recovery rate of 80%, and vice versa. The problem of loss given default is that it is never known before the default, but also when a default takes place, there is still a lot of randomness, a lot of uncertainty. Why? Because the actual loss will only be known at the end of the recovery process. And yesterday I told you that the recovery process can be something extremely random and erratic and depending on many characteristics. There are different things that may impact the loss given default of a given contract. And these are, for example, the characteristics of the exposure. So the questions are very simple. Is there a collateral for the contract, for the transaction? If yes, obviously, if there is a collateral, that is to say something that is there as at least partial compensation and partial insurance against the default, or in order to make you be willing to enter in a contract, if there is a collateral, obviously you can expect the loss given default to be lower, because you can still hope to sell the collateral, to take the collateral, and compensate for the loss. There are other things like, if there is no collateral, is there still a guarantee by a third party? Yes, no. And obviously that impacts. Is there a seniority? It means there are contracts in which there are only two counterparties. And in that situation is simple. But there are also situations in which maybe you are buying an asset, you are buying a security, you are buying a derivative. And what happens? In the case of a default of the counterparty, there is a ranking that, among the creditors. So there are those creditors that are the first one to get their money back. Then there is a second level, a third level, a fourth level, and this is what we call seniority. Obviously, if you are in the highest level, you are among those that get the money back as soon as possible. If you are in the last level, there is good chances that you will have the higher loss if there is no money. Other things are, for example, the characteristics of the counterparty itself. So one thing is to finance something in the oil and gas industry, something different if you want to finance something in IT. Why? Because of the structure of the two different industries, because of the different structure of the type of investments that are needed. If you invest your money, if you give a loan to an oil and gas company, typically they have long time horizons. Why? Or like pharma is the same. Why? Because they need very huge investments, maybe to discover if in a place there is some oil, then they have to take samples, then they have to build infrastructure. So it's not something that happens in 6 months. Okay? On the IT level, it's a little bit easier because if you are financing a small startup with a very clever idea from a software point of view, you understand that the time horizon in front of you is completely different. The country is important. Why? Because the way in which the recovery process is regulated depends on the legal framework of the country. Then you have the leverage and the financial ratio. So obviously, if you are giving money to a company that is highly leveraged, so that is already asking a lot of money from the outside, so that, for example, the debt ratio is relatively high, you can expect that this company is much more likely to default. And you are also in competition with more creditors. If the company is a company that essentially is financing itself almost with capital and equity, then the number of competitors that you have is smaller. So these are all things that obviously impact the amount that you can recover, the duration of your recovery. There is some components that depend on you. Imagine that you are a large bank with a huge experience about recovery money in case of a default. If you have a legal department which is very experienced in that, you are for sure having an advantage with respect to another small bank that has its default for the first time. Okay, because you know how to handle the situation. And also the fact that you know the legal system, how you can exploit that, how you can maybe bypass some problems in the legal system by trying to find an agreement on the private side and this type of things. Finally, there are some external factors. You can imagine that if one of your clients, if one of your customers goes default during a period of boom, and there is some collateral like a house, like a certain number of bonds, it's typically not a big problem to liquidate the assets and get your money back. If, on the contrary, the counterparty goes default in a period of crisis in which many different agents are defaulting, then you may try to sell the house on the market, but all your competitors, the other banks, are also selling houses from their customers. The price of the housing market drop, and then what you can recover is less than what you could expect initially. Okay, so the situation is important, the interest rates, so the macro setting. So these are all factors that impact the quality and the quantity of the LGD, of the loss given default, or if you want, of the recovery rate. There are different types of LGDs that can be computed. The simplest one, if you are lucky enough, is the market LGD. The market LGD is essentially the LGD that we can extrapolate from market prices. What do I mean? Imagine that there is a bond that goes default because the issuer of the bond goes default. If after a few days, when there is the default, it's always a problem because everything is erratic, everyone is in confusion and in pain. So let's say for the first days, it's a problem. There is no clarity at all. But after a few days, typically, also for defaulted bonds, what you observe is that a secondary market opens. A secondary market is a market in which people, and there are organizations and companies that essentially do this business, come and offer to buy the defaulted bond. Obviously, in order to make money out of that, they will not buy the bond at the full price. They will offer a lower price. But for you that have in your hands a defaulted bond, it's still something. So imagine that a defaulted bond trades at 40 cents per dollar. So for each dollar, you just get 40 cents. What do you have? You get that your recovery rate is 40%, and the loss given default is 100 minus 40%, so it's 60%. Now, the problem of this type of LGD, which is actually quite convenient, is that a secondary market needs to exist. And it's not true that you will find a secondary market for all the assets. For bonds, it's typically not a problem. For other things like a mortgage, essentially there is no secondary market. If you need data about this type of market LGD, there are companies that provide those data. For example, Moody's. You have companies like Moody's that also provide ratings that also provide this type of information. And this information is useful because you know that, for example, as I've written there, you know that if you have a bond related to public utilities, then you know that the average recovery is quite okay. It's 70% with a standard deviation that is still okay, so 22%. Let's say that you're lucky enough. In other sectors, these are not numbers. The recovery rate is much lower, and naturally, the loss given default is higher. As I was telling you, in most situations, a secondary market is not available. So you need to compute the loss given default yourself. This is what is called the workout LGD, workout loss given default. Now, how is this type of loss given default computed? On the basis of empirical data. And there are many models. So later on, if you are interested in your career and at a certain point, maybe your master thesis, you will find that there are companies that are highly interested in the modeling of LGD using actual data. What you can use generalized linear models, the logistic regression, the probability regression. Now, a quite hot topic is everything which is related to machine learning. So you can use different type of algorithms, trees, classifications, a lot of things, which are all things that we cover at master level. But what you need is a large data set of historical data, and given this data set, you try to make the estimation. How? For example, you know that your counterparty is in a specific sector, so it's, for example, a pharma company. What can you do? You can use historical data from other companies in the pharma sector and use that information as a proxy for the LGD of your company. Because obviously, when you are estimating the LGD, either the company has not yet defaulted and you hope for the company not to default, or you are still during the recovery process, so you still don't have all the information about the length of the recovery and the final recovered amount. So you are still in need of past data in order to make this type of computations. And naturally, the type of information is the recovered amount, the type of the length of the recovery process, other covariates like the characteristics of the exposure, the characteristics of the counterparty, the environment, and so on. There is a lot of empirical evidence also for this type of things. For example, you can imagine that if you have a retail mortgage, so residential mortgages, in those situations, typically the recovery rate is quite high and the loss given default necessarily quite low. Why? Because there is always a collateral. There is the house. The house is there. The problem can be the length of the recovery, because maybe you have to wait for the right moment to liquidate the asset. But in terms of the possibility of recovery, the amount is not a big deal. If you have an unsecured overdraft, if you have a credit line, typically the recovery is almost zero. From an empirical point of view, there are some funny facts that we will not consider in detail, but since I told you that, for example, the recovery rate and also the loss given default are between 0 and 1, what you observe is that, for example, here in Europe, and this is consistent in the different countries all over Europe. Why? Because our legal systems are quite similar. Okay, there are differences, but they are quite similar. What do you have? You have that the recovery rate has more or less this U shape. This is the empirical distribution, the empirical density. It's just the histogram of the recovery rates. And if you try to fit a distribution, you find that a U-shaped distribution, like a beta, it's a good model. So, for example, a type of regression that is used in modeling the LGD is the beta regression. The interesting thing of the beta distribution is that if you have a beta distribution of parameters A and B, and you take 1 minus that distribution, what you get is another beta distribution in which you switch the parameters, a beta of parameters B and A. So if you can model the recovery rates, you can immediately model the loss given default, and vice versa. So this is all I want to know from you for what concerns the loss given default. It's already sufficient to know that it's a quantity that is not constant, and this is a big improvement, because in Basel II, you will see when you read something about the legislation, In Basel II, in most models, the loss given default was assumed constant and provided by the regulator a number, 0.35, 0.7, depending on the type of exposure. Now, in Basel III and in the evolutions that we are seeing at the moment, what we observe is that the loss given default starts being considered a random quantity that needs to be modeled. It's not just a number that someone gives you. And there is a lot of literature and study about these kind of things, and a lot of money invested in models that can be reliable for the estimation of the loss given default. Now, loss given default aside, we can consider another important risk parameter, which is the PD, the probability of default. Now, we will see together very briefly different ways in which this PD can be assessed. One simple way are credit ratings. Now, credit ratings are objects that you already know for sure. So what is a credit rating? A credit rating is nothing more than a series of numbers, a series of letters, a series, if you want, a series of color, whatever you want. So it's a scale that you use in order to give a signal about the creditworthiness of a counterparty. There are different types of credit ratings, and they all depend typically on the rating agency that generates a rating. So every rating agency, if you consider Standard & Poor's, if you consider Fitch, if you consider Moody's, each one has a different scale, a different type of ratings. So you have, for example, the AAA, you have the combination of Moody's, which is a combination of capital and small letters with extra numbers for classes. Some rating agencies add plus and minus. Some other rating agencies just provide numbers, so 3, 4, 5, 2.5, like this. So, but the idea is that once you have a rating, you can try to assess the creditworthiness of your counterparty. And when you use a credit rating, like for example you do in the standardized approach, in the standardized approach you use credit ratings in order to decide which risk weights need to be used. When you use a credit rating, there is a very important assumption, and it's the fact that all you need to know is the credit rating. Once you know the credit rating, you immediately know what is the probability of default of your counterparty. There is nothing left to say. Once I know that my counterparty is in the BBB class, I know the PD. If it is in the C class, I know the PD. If it is in the AA minus, I know the PD. So as I was telling you, a rating is a description of the creditworthiness of a counterparty. That can be, for example, a corporate bond. Can be, for example, a corporation, a company, a government. But if you want to be very precise and pedantic, actually, a rating is never an attribute of the counterparty, but it's an attribute of an asset or of a bond issued by the counterparty. When you say that a country like Germany is AAA, is because you are making inference from the fact that the bonds issued by Germany are AAA. And since all the bonds issued by Germany are AAA, then you say Germany is AAA. But in principle, this is not true. You can have situations, and we have observed the situations in which, for the same company, you could have slightly different ratings on the different bond issues, depending, for example, on the maturity. Because you can imagine that if it is a bond that is repaid in 1 year is one thing, if it is repaid in 30 years is another thing. Okay? Again, it's not that for the same issuer you will move from a AAA to a C. They are close. But it's not true that they are necessarily the same. So that's why it's totally fine when you say that that company is a BBB, fine. But if you want to be precise, you should remember that essentially you are forcing a little bit the fact that the triple B is the bond issue, not the company. Now, the big rating agencies are typically Moody's, Standard & Poor's, and Fitch. They account for the large majority of the rating market. There are other interesting companies doing the same type of job. And in the last years, you can also observe the birth of new companies that, for example, try to use what they say artificial intelligence, actually algorithm of machine learning. They try to extrapolate this rating information. And some interesting things are coming out. So it's definitely an important market, and we will see many novelties in the next years. Now, a very important concept that is related to ratings is this division. In this course, we mainly focus on the ratings of Moody's, Standard & Poor's, and Fitch. What we have is that these ratings, apart from the letters, or the fact that one company uses all capital letters and the other one a combination of capital and small letters, but this is totally irrelevant. What we have is that the rating classes as given by these companies are assumed to be comparable. So it will be very, very difficult to observe a company that is given a AAA according to Fitch, and it's perceived as much more riskier according to Standard & Poor's. Okay, they typically tend to be comparable. Not saying that they coordinate, but you can imagine that they watch one another. So they always control what the other two are doing. Okay, so a natural coordination emerges on the market. Now, an important concept is the concept of investment grade and speculative grade. If a bond has a rating with respect, for example, Standard & Poor's of BBB minus or above, it's called investment grade. If it is below, it's called speculative grade. Why is this important? Because we will see that, first of all the investments that are in the investment grade are perceived as safer. Those in the speculative grade are perceived as riskier. So from an investment in the speculative grade, you expect higher returns. Otherwise, if you are risk averse, it's not for you. But if you are a bank, and if you are a large bank, and I'm speaking about banks mainly interested, for example, in the retail and the commercial business, what you have is that you might have limitations from the side of the regulator in the type of bonds and assets that you may actually have on your balance sheet. There are very important limitations, for example, for bonds that are in the speculative grade. It's not that they cannot buy them, but there are rules. It's not as simple as one might think. That is, I go on the market and I do whatever I want. It's not. It's not like that. If you are in the investment grade, you are somehow safe. Okay, let's put it in this way. And please notice that this type of classification is also very important from a monetary point of view, because for example, the European Central Bank can buy govies, can buy bonds from the different countries in the Eurozone, and then obviously for generating liquidity and financing the system, mainly if they are in the investment grade. So for a country, going into the speculative grade in terms of bonds is not something that you would hope. Why? Because then you are essentially telling to the ECB that they cannot do anything, because you are essentially bending their hands. So they cannot actually do anything because they cannot enter into the speculative grade. So it's quite important, this distinction. Now, how are these ratings produced? There are different types of models that can be used. you can also find something more on right space. Typically, the type of models that are used here are generalized linear models, as we call them in statistics. You can call factor models if you want to use a slightly different classification, but they are not particularly complex models. The point is that those models, in order to be somehow reliable, require a very large amount of data. And that's why companies like Moody's, Standard & Poor's are in a sort of oligopoly. Why? Because they have the power to have this data, because they started many years ago to collect the data. So they have a sort of advantage given by the fact that they are on the market. They have been on the market for several years, and they have a lot of information about the market. Now, what they do typically, they do very simple things. Now, to simplify a little bit, the job of a rating agency when there is a new company is to do the following. They have to decide at time zero, let's say when for the first time they have to give a rating to a company, in which rating class this company is. Is a AAA, is a double B, is a B, is a triple C, I don't know. In order to do that, they will compare this company with other companies that are already in their dataset in terms of business, in terms of size, in terms of financial ratios. And typically they take these informations, they put this information in a formula, which is usually coming out of a generalized linear model. They get a score, and this score is used to say this is the class, not, or conversely, this other class. After that, what do? They just monitor over time the different companies in the data set. So imagine that at time zero you have 100 companies split among the different rating classes. What can you do? The next year, also at time 1 year after, what you can do? You can count how many companies from one class defaulted, and then you will have an approximation of the probability of default for that class over the total, obviously, of the companies. Or you can count how many companies moved from the first class to the second class, from the third class to the first class, and so on. So every year what you have to do is to verify in which class a company is, and then by just computing the transition probabilities to the different classes, including the last one, which is the class of default, you have this information about the transition. Now, the point is that, and it's very important, if you are a rating agency, something that you don't want to do is the following. I'm paying you because I want information about the creditworthiness of one of my clients, and I come to you and you tell me this guy is rather reliable because it's an A. Fine. And then 1 week after, you change your mind. You say, no, it's no longer A, now it's B. And then maybe after 1 month, you say, no, it's back to A. So what you want to do if you are a rating agency is to give a guarantee to the market that the ratings you provide are reliable. They are somehow stable. It does not mean fixed, because it can always happen that even a very strong company is subject to something tremendous that completely destroys the company or make the company less creditworthy. Fine. But on average, you want the ratings to be stable and reliable. Why? Because people are investing their money on the basis and taking their financial decisions on the basis of those ratings. So what rating agency wants to avoid is the so-called rating reversal, the fact that you give a sign rating and after a few days, a few weeks, you change your mind and you go to another type of rating. In order to do that, what rating agency try to do is to give information about the rating that go through the cycle. So when they provide information about a counterparty, when they provide a rating for a counterparty, rating agencies tend to give a rating which is not immediately dependent on the contingent business cycle. Okay? Because you can imagine that during a crisis, everyone has a higher risk of default. During a boom, everyone, more or less, has a lower risk of default. So By taking long time averages, you are trying to minimize the impact of the contingent business cycle, which is still important, but is not the type of information that you want for a rating. A rating needs to be stable over time. For the business cycle information, there are other things like what we call the point-in-time probability of default, which is nothing more than imagine that I'm evaluating a counterparty. I know that that counterparty is more or less on the B level, and now I'm also interested in knowing how far from the B level it is in this specific day. And then I can have the point-in-time estimate of the PD and discover that today, for some reasons, it's a little bit more risky, or today is a little bit less risky. Okay? Now, when you are playing with ratings, essentially you are playing with an object like this. You have a big table that we call transition matrix, in which you have the different rating classes. Here in the matrix I'm showing you, I'm just showing some of them. And you have the so-called transitions. What do I mean? Imagine that you are a company in the AAA class. It means that you are in the first row. If you look at what is the probability for you to be still in the AAA class at the end of the year, this is almost 91%. So it means that if I'm giving my money to a company that is in the AAA class, there is a very good chance that in 1 year from now, that company will still be in the AAA class. But I can also be somehow sure that there is a chance, which is not at all zero, it's 8.32%, for example, in our data, that the same company could have a downgrade to a AA class. That would be, for example, what we called yesterday migration risk, moving from a AAA class to a lower class. And what's the probability of default in 1 year from a AAA class? You see from the table that it is essentially zero. Actually, it is not zero. It's very wrong and dangerous to say that a AAA class has a probability of default equal to zero. It looks zero because I stopped at the second decimal. Actually, it will be 0 point, a certain number of zero, and a small one there, because remember that everyone can default. Okay? Always think about what happened to companies like Lehman Brothers, Enron, and so on. If, for example, you consider an A class has, again, a probability of 91% to stay in the same class. And this makes sense. If you are in a class, typically the higher chances that you stay in that class, also because of the fact of the rating stability we were discussing before. But, for example, the same company has a probability of defaulting of 0.06%, which is small, but is not zero. A company in the triple C class, for example, has a probability of default which is almost 20% in 1 year. So it's quite big, definitely big. Now, the same rating agencies, when they provide information about the transitions, so what do you have to do? Imagine that a client knocks at your door, tock, tock, I want some money, and you say, okay, let's see if there is a rating for you. According to the market, according to the rating agency, you are a AA. Okay, if you are a AA, I immediately know what your PD is. And I can use this PD for my computations if I want to use credit ratings as an approach. We will see that not all counterparties have a credit rating. So it's totally fine that Apple has a credit rating, that Google has a credit rating, that Novartis has a credit rating, that ING has a credit rating. But no single shop here in Delft has a credit rating. It's not that you can go to Moody's and ask what's the credit rating of the Beer Fabrik. Okay? You will not get that information. How can you deal with that? You have to compute the rating yourself according to some model. This is what we will call an internal rating. So computed internally with respect to the bank, according to some models that we can consider. But when we consider the big players, those for which an external rating, that is to say a rating provided by the rating agency, is available, you will see that when you open a publication of Moody's, when you open a publication of Standard & Poor's, some of these data are public. And I really suggest you to, if you are interested, to spend some time on Google and find this type of reports. Others are not public because it's their core business, so they want to be paid in order to give that information. But they also provide, together with the transition matrix, this type of matrices in which they provide the cumulative probability of default. In the transition matrix we have just considered, we have the probability of default or moving from one class to the other in 1 year. But depending on the time horizon of your investment, you might be, for example, interested in knowing what is the probability of default within 2 years, within 3 years, 4 years, and so on. And they provide a quite precise estimate of this probability of default for several time horizons. Typically, up to 15 years, that information is available. After 15 years, you have some approximation. So maybe you don't have the data for 16 years, you have the data for 15 and 20. Okay, so you can use this information to make your considerations. Since this is a cumulative probability of default, it's trivially increasing over time. And for example, imagine that I'm interested in knowing what is the probability of default of a CCC bond by the end of the second year. What I do, I go in a table like this and I find this value, the probability of default by the end. And please now, and we will continue after the break, it's very important that you pay attention to the expression. By the end of the second year, it means that I'm interested in knowing what is the probability that my counterparty that has a CCC rating goes default from now until the end of the second year. It can be tomorrow, it can be in 6 months from now, it can be in 18 months from now, it can be in 24 months from now. So I'm interested in what happens from now and 2 years. So within, by the end of the second year, okay? Because we will see that, for example, if I ask what is the probability of failing during the second year, this is a totally different animal, okay? We continue after the break.